Welcome back. So this is the part 4 of the AF3110 IA1 Week 9 topics on financial asset part 2. Just shortly before the break, we have looked at a comprehensive example that covers the three-stage impairment loss model, right? We call that general models. But under HKFRS 9, there is an exceptional model, okay, known as simplified model that can in fact be used for certain companies. So basically, the model includes some operational simplifications for trade receivable, contract assets, or even lease receivable, if they are often held by entities that do not have a sophisticated credit risk management systems. So that means to eliminate the needs to assess when a significant increase in credit risk has occurred. Now notice that that applies to trade receivable. Okay, it doesn't apply to like other things like bonds, all right, or debts for even longer durations. So it applies to trade receivable specifically. For trades receivable or contract asset that contains no significant financing component, that means usually they have a receivable period of 1 year or less, then you can simply use loss allowances equal to lifetime ECL, because it's anyways a very short period. It's less than one year anyway. All right, so discounting is not a major concern at initial recognitions and throughout the life of the receivable. Or when it contains a significant financing component and also related to lease receivable, the company then will have an accounting choice in between using simplified model, which would determine loss allowances equal to lifetime ECL at initial recognitions throughout its life, by using what they call the provision matrix, which I will show you an example at the bottom of this slides, or simply apply general model. That's a choice for the company to choose, and this choice must be applied consistently. But the company can apply the policy elections for trade receivable, contract assets, and lease receivable independently of each other. So that means the three items, trade receivable, contract asset, and lease receivable, the company can choose which model they prefer, simplify or general models to choose. Alright, okay, let's look at an example then. Determine the general entries of a loss allowances at 30 of June 2021. The company SWTFA has a customer base consisting of a large number of small clients. At the 30th of June 2021, it has a portfolio of trade receivable 68 million. The company used a provision matrix simplified model. Is based on a historical observed default rates such as this one, the default rates, and adjusted for forward-looking estimates. So what they did is they split it like in terms of how many days overdues and assign a possible default rate for each one. And then of course, based on the overdue data, they split the 68 million in terms of different amounts that with respect to each of the due date or still hold, and multiply by the respective default rate. Okay, so A times B equal to that column C added together. That would be the loss allowances balances as at the 30th of June 2021. The company actually has a loss allowances figures already recognized last year at 2020 30th of June, which is 1.16, and the balance now is 1.648. Obviously there were just a difference, as this year's entry debit impairment loss credit loss allowances for 488,000. That's it. Alright, so we've completed everything on impairment loss for our financial asset, particularly for the debt one. So now let's have a look take a look of the final topic, which is derecognitions. The idea is to remove the item, right, of your financial asset, right, that are on the statements of financial position, and you now want to remove it. You can remove it under two situations. Number one, when the contractual rights to the cash flows from the asset expire, i.e., if it is a bond with a 3 years duration and the redemption value is 1 million at the end of the durations, and you get back that redemption value at the maturity date, right? Then in fact the contractual right would then be complete, right, and expire, and therefore you can de-recognize this debt, this bonds, or it transfer the financial asset, and that transfer qualify for 2 or 3 de-recognition tests, which are the 3 here. In blue color, asset transfer test; in the green color, risk and reward test; and in the red color, contract test. 2 or 3 of this test satisfy. And here comes the full table, which you can see from the top. And I will go through them in, basically in 3 to 4 blocks. Okay, so if the rights are expires, the contractual right to receive cash is expired, then obviously de-recognize it. If not, then you would consider asset transfer tests. Have you transferred the asset? I.e., if you are holding some receivable and you want to get the money as early as possible, you may sell this receivable to another party, a third party, and that third party would give you the money, right? And then of course you would settle that you can de-recognize your receivable. However, if you have a commitment, to ensure that that third party can in fact receive at least 90% of the full amount of the accounts receivable, then that means you have an obligation, right, to to ensure that the third party can receive the money. Then you may have to consider to continue to recognize your financial asset, all right, or you have to consider whether there be any transfer of the risk and rewards of that assets, or you have transferred it to the third party, the buyer. And finally, would you still control that asset after all, right? So we will talk about that in different parts. Let's start with the easy one. When the contractual rights to receive the assets, the cash flows from the asset expire. Okay, this is easy because we have gone through many examples of that. Okay, so let's look at the example and try to understand it from the example then. Prepare a journal entry for the derecognitions of the above 2 cases. The carrying amount of the financial asset carried at amortized cost is 26,300, and the entity will receive the principal, that means the residual redemption value of 26,300 when the right to receive cash flows expires. Okay, so you receive the money equal to your principal at the maturity date, so the entry is quite simple: debit bank, credit financial asset. In second example, if you classify the financial asset as fair value through OCI, and previously you have recognized some fair value gain in equity, which means you are now reporting those fair value gain in the fair value reserves equal to 2,200, right? And the carrying amount of the financial asset before derecognitions is in fact 28,700, and the entity will receive 26,500 when the asset is derecognized. So what would you do then? Well, let's deal with the money that you receive. You receive 26,500, and then you credit the financial asset by 28,700. The difference must be a loss on disposal. And because you did have a gain of 2,200 from the fair value reserves, then what you have to do is, in fact, you would go through a pair of adjustments. Okay, reclassification adjustments. Of course, we are referring this as the what? As a debt investment rather than the equity, and therefore you would obviously you would debit the reclassification adjustments. That would eliminate all the gain from your fair value reserves eventually, and credit the reclassification adjustments P&L. That would eliminate your loss on disposal. Okay, so the whole idea is to recycle the unrealized fair value gains to P&L through this pair of entry. All right. Okay, let's then talk about asset transfer tests. The idea is, do you have transfer the entire rights to receive cash from, for instance, accounts receivable to your third party? Do you still have the obligation to ensure that third party can receive certain percentage of the money from your original customers? Okay, so when an entity transfer financial assets that fulfill the asset transfer test, that entity is required to evaluate the extent to which it retains the risks and rewards of the ownership of the financial asset before it can derecognize the financial asset. So if you did transfer it, right, the assets, but not really at the expiry date of this items, right, and which means yes here. Then the next question is, you have to consider the whether you have transfer or retain the risk of and the rewards of the ownership of the assets. Okay, so what would be the example that we would consider here, or we will talk about that here? The two examples we will talk about that here is repurchase agreement and factoring. Let's talk about factoring then. Okay, factoring. In the factoring transactions, one party, the transferor, transfer the right to some receivable to another party, known as factor or transferee. So you are the factorer, you've got some accounts receivable, and you sell it or transfer it to a factor or transferee, and that transferee will give you immediate cash payments. Right? Factoring arrangement would then be either with recourse or without recourse. Without recourse means the transferor does not provide any guarantee about the performance of the receivable. So that means it would not guarantee whether the factor can in fact receive all the money back from your original customers. In such transactions, the entity, that means the transferor, has transferred the risks and rewards of the ownership and should derecognize receivable, because you have no more any obligations for this further cash flows, and the risks and rewards has been passed of this asset has been passed to the transferee, the factor. In this case, you must derecognize that receivable, okay, and then debit the bank for the money that you receive from the factor. In the case of with recourse, the transferor fully or partially guarantees the performance of the receivable. Therefore, the transferor has not therefore transferred fully the risk to another party, and it is likely that the transferor cannot derecognize this receivable, but instead the transferor would treat the money received as like a loan. Okay, so let's see the two examples for the illustration. Okay, ABC, the transferor, has receivable measured at 10 million. It sells receivable in the factoring transactions without recourse to XYZ. XYZ is the factor for 8.5 million of cash. Without recourse, that means risks and rewards has been transferred fully to the factor XYZ. So the receivable, the financial asset, must be derecognized. So ABC should derecognize that receivable as it transfer the risks and rewards to XYZ. Therefore, of course, it should in fact credit the receivable by 10 million and debit the cash 8.5. Also debit a loss on the disposal of 1.5 million in P&L. Okay, say it again, debit the loss on disposal 1.5, debit bank 8.5 million, and then credit the receivable 10 million. Second example, BCD has a receivable measure at 10 million, the same value. It sells receivable to factoring transactions with full recourse to STU, the factor, for same price, same cost, same price, 8.5 million of the cash. BCD guarantees to reimburse STU in cash if the receivable realized less than 8.5 million. So therefore, the BCD still retains some risk and rewards on that receivable. So in this case, we cannot de-recognize that receivable, cannot. So BCD has transferred the right to receive the receivable to STU, but BCD has not transferred all the risk and would continue to recognize that receivable in BCD financial statement and then recognize the money that received it by debiting the bank and credit a financial liability, or if it is in this case it could be considered as a loan from the factor, which is STU. Okay, well, let's look at the second example for risk and reward test, and this time we will look at repurchase agreements. Don't confuse this repurchase agreement with the one you've learned from revenue. In the case of revenue, is in fact you are selling an inventory which is non-financial asset in nature, and then you are committed to buy it back at a different price in future. This is to sell a financial assets, which you then simultaneously buy it back in some future time at a specified price, which may be the future market price. Okay, so we are in fact evaluating the possible risk here, the risk of having exposure to the change in the cash flows before and after the transfer here. Okay, so if the repurchase price is almost fixed, then in fact the kind of exposure to future cash flows would then be relatively stable or low, right? But then if the repurchase price is subject to future market price, then there would be a huge, of course, of exposure to risk in terms of change in cash flows. And if the exposure is low, then in fact, beta would the seller would tend to retain substantial risks and rewards. Okay, but if the risk is going to be high, then you may claim that in fact the seller has transferred substantially all the risk and reward of the ownership of the financial asset to the buyer. Well, let's look at the two examples. Beta has sold a debt instrument to a third party, subject to an agreement to buy it back at a fixed price or at the sales price plus a lender's return. So in terms of the exposure to the change in the cash flows before and after, this is almost certain, right? Price is either fixed, repurchase price is either fixed, or sales price plus a certain return. In this case, beta has retained substantially all the risks and rewards of this financial asset, and in that case should continue to recognize the financial assets. But for the money that the seller received would then be debit bank and recognize a financial liability, credit a payable or a loan. And then for the second case where beta sold another debt instruments and subject only to an option to buy it back at its fair value at the time of repurchase. So beta won't be able to know the repurchase price for certain. So in this case, beta has transferred substantially all the risks and rewards of the ownership of that financial asset. So should you recognize the financial assets? Okay. And finally, we will look at control tests. So if we cannot prove that we have transferred the risks and rewards or retain the risks and reward, then it comes to the final part. Has the seller retained the control of the financial assets? If the answer is no, derecognize it. So determine whether the control of the transfer asset is retained. An entity ascertains whether the transferee has ability to sell the asset eventually. So can the transferee, i.e. the buyer, the ultimate buyer, right? So you sell the financial asset to a third party, a buyer, right? Can the buyer able to sell this asset? If the answer is yes, right, then in fact there's no problem to there is no problem to say that you have retained the control. If you don't retain the control, you can derecognize the asset. So if the transferee, the buyer, has the practicability to sell the asset in its entirety to an unrelated third party and is able to exercise that ability without much hesitation and without needing to impose additional restriction on the transfer, then the seller has not retained control. And because the seller does not control the transferee's use of asset, then lost control. Derecognize the assets. Okay, last slides. Okay, just want to show you a little bit about how to present the financial statement on the face of the statements of financial position. So if the financial asset is held primarily for being traded, which is held for trading, it is likely to be classified as current assets. No doubt we know it, because it is usually sold within 12 months. If the financial asset is not held for trading, it is classified according to its expected life to be realized in or is intended for sale or consumption and the entity's normal operating cycle. It can be both current and non-current, and typically if we were having like a bond, for instance. In practice, it applies commonly to debts only, since it is difficult to estimate the timing of the dividend income from an equity investment. So in this case, when you were looking at the balances of this debt as at the end of 2018, it has a balance of 48,167, right? So for this amount, we know that out of this 2,000, which means to be received in the next 12 months, should be considered as current. Then if you take the balance minus 2,000, this would be non-current. All right. And if you look at the balance at the end of 2019, 49057, and for the next 12 months, obviously the whole balance would be received. So therefore, this number as at the end of 2019 should be current assets. Okay, so I'm sure that you've learned a lot already for this week. Okay, so next week we're going to look at a new topic, which is impairments of assets, and this time we will look at impairment of asset other than financial assets. Okay, so that's about it. See you next week.